When people think of Wall Street collapsing, they imagine a gradual decay, a slow erosion of trust, or a financial scandal bubbling for years before it bursts. But history teaches otherwise. Collapses are rarely long, drawn-out funerals. They are sudden heart attacks. The market doesn't whisper before it dies. It screams in an instant. The triggering move is never what most expect, and that is what makes it so devastating. It comes disguised as an adjustment, a technical maneuver, or even a harmless shift in numbers. Yet beneath the surface, that single motion pulls the pin from a grenade that detonates across the global economy. Picture a single trade executed by a major institution. On the surface, it's routine. A hedge fund rebalancing its portfolio. A sovereign wealth fund adjusting its reserves. A central bank recalibrating its currency exposure. The newspapers may not even cover it. But in the age of high-frequency trading and algorithm scanning every tick of movement, a single adjustment can set off a cascade. Computers don't think in terms of strategy or long-term vision. They react instantly, without hesitation, without mercy. And when those algorithms detect what looks like a signal of crisis, they all rush to the exit door at once. The move becomes amplified, multiplied, weaponized by speed. In minutes, a minor shift snowballs into billions being wiped out. The power of the triggering move lies in the fragility of the system. Wall Street sits on a tightrope where confidence, not fundamentals, dictates survival. Investors pour in because they believe tomorrow will be brighter. Pension funds remain invested because they trust Wall Street won't betray them. But this trust is not built on rock, it's built on air. The very architecture of the financial system is constructed on leverage. Borrowed money, stacked upon borrowed money, inflated valuations, justified by projected future growth. All it takes is one sign, one unexpected action to shatter that delicate illusion. Imagine a foreign government suddenly deciding to liquidate its US Treasury holdings. They don't announce war, they don't deliver threats, they simply sell. That move alone could send yields spiking, bonds crashing, and equities reeling. Now imagine an American tech giant revealing overnight that it can no longer meet debt obligations because its buyback-driven bubble has imploded. The ripple effect would be immediate. Suppliers panic, banks tighten liquidity, credit markets seize. Even more terrifying is the scenario where the triggering move comes from the invisible corners of finance derivatives, swaps and synthetic instruments, so complex that even regulators don't fully understand them. A single miscalculated bet exposed suddenly could unwind trillions in obligations, leaving Wall Street gasping for liquidity it does not have. The triggering move doesn't have to come from greed alone. Fear can be equally destructive. If a leading bank quietly restricts lending, the world interprets it as a sign of hidden weakness. The whisper spreads, if they are hoarding cash, something must be wrong. Traders react not to facts, but to fear. And fear is contagious. Once trust evaporates, even healthy institutions become targets. Stock prices collapse, not because they should, but because everyone believes they will. Self-fulfilling prophecy replaces rational analysis. What makes the triggering move so dangerous is its speed. Traditional finance was once cushioned by time. A trade executed in London might take hours to affect New York. A rumor in Tokyo would crawl the globe over days. But now, markets breathe the same second, the same tick of data. A sell order in Shanghai ricochets into Wall Street terminals in less than a heartbeat. Algorithms respond, in microseconds, creating a storm no human can stop. By the time regulators even notice the collapse, it's already too late. Markets are no longer controlled by men in suits. They are controlled by codes written to chase profit faster than thought itself. Consider how this dynamic transforms the risk profile of Wall Street. If an oil-rich nation suddenly decides to shift reserves away from dollars, the currency market trembles. High-frequency traders, reading the tremor, begin dumping dollar-backed assets. Stock traders, seeing currency weakness, offload equities. Credit markets respond by jacking up interest rates. Within hours, what began as a quiet portfolio adjustment morphs into a crisis. A move intended as financial housekeeping instead exposes the fragility of the entire system. The chain reaction is unstoppable once it begins, because each market is now a reflection of the other. Stocks depend on bonds. Bonds depend on currencies. Currencies depend on commodities. And commodities depend on speculation. Break one link and the whole chain collapses. The real terror lies in how small the triggering move can be. A fund deciding to unwind a few billion in positions. A central bank shifting policy slightly earlier than expected. A corporation missing earnings by a few cents. None of these seem catastrophic on their own. Yet, when amplified by the machinery of Wall Street, they become existential threats. It's the equivalent of a pebble causing an avalanche. The size of the pebble doesn't matter. What matters is where it lands and how unstable the mountain already is. Wall Street has conditioned itself to ignore such risks. For decades, it has operated under the illusion of invincibility. Every crash has been met with intervention. Every collapse cushioned by bailouts. Traders and investors have grown accustomed to the Federal Reserve stepping in as savior. This complacency is precisely what makes the triggering move lethal. When the next collapse begins, the system may discover that its safety net has holes. Intervention requires time. And in the modern financial age, time no longer exists. The collapse will happen faster than solutions can be crafted. Look back at history. The Great Depression wasn't triggered by the economy simply running out of steam. It was accelerated by panic selling after small initial shocks. The 2008 financial crisis didn't begin with millions of foreclosures overnight. It began when one bank, Lehman Brothers, made a move that exposed the weakness of the system. Once trust collapsed, the dominoes fell. Each crisis begins with a spark, and each time the world is surprised by how fast the fire spreads. Yet today's world is far more combustible. The kindling is higher, the wind stronger, the sparks more plentiful. The triggering move is inevitable, not because markets are evil, but because markets are human. They are ruled by greed, fear, and the illusion of control. No algorithm can predict the exact day, the exact moment, but the conditions are in place. The world has been lulled into complacency, believing that as long as money flows, nothing can break. Yet fragility hides beneath abundance. The very abundance of credit, speculation, and leverage is what ensures that a single motion can ignite collapse. The lesson is clear. It won't be a war, a headline, or a grand announcement that starts the fall. It will be a single, seemingly minor move. One decision, one adjustment, one action that nobody recognized as the spark until it was too late. Wall Street presents itself as the epicenter of financial power, a fortress built on the principles of capitalism and innovation, where fortunes are made and global economies are influenced. To the outside observer, it looks unshakable, a system so deeply entrenched in the modern world that its collapse seems unthinkable. Yet behind skyscrapers of glass and steel, beneath the noise of the trading floors and the endless parade of quarterly earnings reports, lies a vulnerability so profound that it contradicts the very image of strength. The hidden fragility of Wall Street is not in the headlines or the surface-level market moves, but in the architecture of the system itself. A design that prioritizes appearances over stability, leverage over substance, and confidence over truth. This fragility begins with the reliance on debt. Debt is the oxygen that fuels the machinery of Wall Street, allowing institutions to expand their influence, multiply their investments, and create wealth that appears limitless. But every layer of borrowed money adds weight to a structure already stretched to its limits. Corporations borrow to repurchase their own stock, artificially inflating value. Banks borrow to lend, lending to those who also borrow in return. Hedge funds take on leverage to amplify small bets into massive gambles. Pension funds, meant to safeguard the futures of millions, are pushed into risky assets in search of higher returns because the debt-fueled economy leaves them no choice. On paper, it all appears as growth, progress, and expansion. In reality, it is a castle built on quicksand, where one misstep causes the ground to collapse beneath. Consider how this dependence on leverage has distorted the very definition of value. Stocks no longer rise simply because companies grow stronger. They rise because cheap money flows endlessly into the system. Corporations manipulate earnings through accounting maneuvers while investors focus on forward guidance rather than current reality. Markets celebrate projections instead of substance, betting on what might be instead of what is. When the foundation of valuation is expectation rather than evidence, fragility becomes inevitable. Any disappointment, any deviation from the promised narrative causes fear to ripple through the market. The hidden fragility reveals itself in how violently Wall Street reacts to even the smallest pieces of bad news. Another layer of weakness comes from the complexity of the instruments Wall Street has created. Derivative swaps and synthetic securities dominate the financial landscape. Products so intricate that even those trading them often cannot fully grasp the risks involved. These instruments are justified as tools for hedging and efficiency, but in practice, they are mechanisms of speculation. They multiply exposure, creating hidden linkages across markets that make the entire system more brittle. A shock in one area, whether in mortgages, commodities, or foreign exchange, quickly spreads through these connections, turning what should have been a contained problem into a global crisis. Complexity becomes camouflage, hiding danger until the moment it erupts. Confidence is another illusion holding Wall Street together. The markets thrive on perception, and as long as investors believe in the system, it continues to function. Banks assure the public that their balance sheets are strong. Corporations reassure investors that growth is sustainable, and governments promise regulation is sufficient to prevent disaster. But these reassurances are carefully crafted performances. Behind closed doors, insiders acknowledge vulnerabilities, discussing liquidity shortfalls, overextended credit lines, and exposure to risky assets. The public never hears these conversations. What they see instead are staged displays of optimism designed to keep them invested. This gap between reality and perception is the very essence of fragility, because once the illusion is pierced, panic takes hold, and no amount of reassurance can restore what has been lost. The fragility also comes from concentration. A handful of massive institutions dominate the financial landscape, controlling not only markets but also policy through their influence. These firms are considered too big to fail, but that label is not a badge of honor. It is a confession of vulnerability. If one of these institutions falters, the system cannot allow it to collapse because its tentacles stretch into every corner of the economy. Yet propping them up only deepens the illusion of strength, hiding the fact that the system cannot stand without constant support. The very size that makes them appear formidable is what makes them dangerous. In truth, the entire structure depends on a few giants whose collapse would unravel everything. Technology has only deepened the fragility. High-frequency trading and algorithmic systems dominate modern markets, reacting to changes in milliseconds. They bring liquidity in good times, but in moments of stress, they amplify volatility, pulling liquidity away instead of providing it. Markets no longer move solely on human decisions, but on automated reactions, where a small tremor can trigger massive waves of selling. This automation means fragility is not just hidden, it is accelerated. A system once thought to be buffered by time now has no buffer at all, with collapses occurring faster than any regulator or institution can respond. The hidden fragility is also geopolitical. Wall Street relies on the assumption that the world will continue to trust the dollar as the backbone of global finance. But trust is not eternal. The rise of alternative currencies, shifting alliances, and rival economic blocs creates cracks in that foundation. If faith in the dollar weakens, Wall Street's power weakens with it. Yet the narrative presented to the public denies this possibility, reinforcing the illusion of permanence. Behind the scenes, however, financial leaders prepare for contingencies they will never speak about openly. The cultural mindset of Wall Street adds yet another layer of weakness. Short-term profit is rewarded above all else, and long-term stability is sacrificed in the process. Executives chase quarterly earnings to satisfy shareholders. Traders chase quick wins to secure bonuses, and institutions chase short-term gains to prove relevance. This culture breeds recklessness with no incentive to build resilience. It is easier to inflate bubbles and hope someone else bears the cost when they burst. The fragility is not an accident. It is the logical outcome of a system designed to prioritize appearance over endurance. What makes this fragility so hidden is that it is wrapped in the clothing of success. Rising stock markets, record corporate earnings, booming housing prices, all these signs suggest strength. But each rise is powered by the same unstable forces: debt, speculation, leverage, and illusion. Like a bodybuilder inflated with artificial enhancements, the strength is cosmetic, not organic. Beneath the surface, the organs are failing, the structure unsustainable. And when the mask finally slips, the world will see that what looked indestructible was, in truth, the most fragile system ever built. When Wall Street trembles, the world does not stand still. The very structure of the modern financial system is built on interdependence, where no market exists in isolation. The United States may host the beating heart of global finance, but its arteries and veins stretch into every corner of the globe. What happens in New York within a single trading session sends shockwaves that rattle the banks in Frankfurt, unsettle the exchanges in London, shake the trading floors in Hong Kong, and destabilize the fragile markets in South America and Africa. This is the reality of the global domino effect, an interconnected system where one fall triggers another, and before anyone can react, the entire structure is already in motion. The first and most direct link is through capital flows. Investors, whether sovereign funds, pension managers, or retail traders, do not keep their money confined to one nation. They diversify across continents, pouring billions into stocks, bonds, commodities, and currencies. This diversification is celebrated as strength, but in times of crisis, it becomes a liability. If Wall Street collapses overnight, those global investors are forced to liquidate holdings elsewhere to cover losses at home. A margin call in New York translates into panic selling in Tokyo. A liquidity freeze in Chicago sparks a fire sale in London. The collapse moves not by geography but by necessity, as investors scramble to protect themselves, dragging down markets everywhere in the process. Currencies are another domino waiting to fall. The US dollar remains the reserve currency of the world, the benchmark against which others are measured. If Wall Street collapses, confidence in the dollar falters, and when the dollar trembles, every other currency feels the weight. Emerging markets, heavily dependent on dollar-denominated debt, find themselves crushed as their obligations become unbearable overnight. Their central banks attempt to intervene, but with limited reserves, they can only hold out for so long. As currencies weaken, imports become unaffordable, inflation skyrockets, and political instability follows. A collapse that began in the skyscrapers of Manhattan soon finds its way into the streets of cities thousands of miles away, where ordinary people pay the price for decisions they never made. The domino effect extends into trade. Wall Street is not merely a marketplace for stocks. It is the confidence engine that drives global commerce. When that confidence collapses, shipping orders are canceled, supply chains freeze, and commodities swing violently. A Wall Street crash doesn't just reduce the wealth of investors, it disrupts the flow of oil, wheat, metals, and machinery across borders. Factories in Asia, dependent on American demand, suddenly face cancellations. Farmers in Africa, who rely on commodity exports, watch prices plummet. European manufacturers find credit lines withdrawn, unable to fund production. The financial crisis mutates into an economic one, where the dominoes falling on trading screens translate into empty shelves, closed factories, and rising unemployment in the real world. Banks are among the most vulnerable links in this chain. The global banking system is intertwined with institutions lending and borrowing from one another across time zones. A crisis in Wall Street immediately affects liquidity worldwide. European banks holding US securities face massive write-downs. Asian banks reliant on short-term dollar funding find themselves locked out. Latin American banks, already fragile, collapse under the strain of capital flight. Interbank trust evaporates, credit markets freeze, and the world economy grinds to a halt. A single default in New York may cascade into a banking crisis spanning multiple continents, each domino toppling the next until the entire structure lies in ruin. The domino effect is not purely financial. It is also psychological. The modern global economy depends as much on sentiment as on numbers. Investors act not only on facts, but on fear. And fear spreads faster than any algorithm. News of a Wall Street collapse doesn't stay in America. It flashes across screens in every language, carried by media outlets that magnify the panic. Traders in Frankfurt wake up to losses they cannot comprehend. Business owners in Mumbai wonder if their credit lines will survive the week. Politicians in Brussels, Beijing, and Brasilia are forced into emergency meetings. This collective fear magnifies the crisis, ensuring that even countries less directly exposed to Wall Street find themselves dragged into the abyss by sheer contagion of belief. The dominoes also fall through geopolitics. Wall Street is more than a marketplace. It is a symbol of American dominance. A collapse would not only weaken the US economy, but also erode its global influence. Rivals would seize the opportunity to push alternatives, whether in the form of new trade blocs, regional currencies, or competing financial centers. Yet these shifts, rather than stabilizing the world, would deepen the chaos. Competing systems mean competing interests, and in the vacuum of a collapsing Wall Street, nations would scramble to secure their own advantage. Trade wars currency disputes and diplomatic tensions would erupt, each one another domino amplifying instability rather than containing it. Even technology plays a role in this global cascade. Financial markets are not isolated servers. They are globally connected networks where information travels instantly. A sell order in New York can trigger automatic adjustments in Singapore, London, and Dubai within seconds. The speed of these transactions means there is no time to absorb shocks. Gradually, the fall is immediate, synchronized, and merciless. Technology, once hailed as the safeguard against inefficiency, becomes the accelerator of collapse, ensuring that no domino remains standing long enough to resist the force of those already falling. The fragility of emerging markets makes them the easiest dominoes to topple. Countries dependent on foreign investment, tourism, or resource exports lack the buffers to withstand sudden capital flight. When investors flee to safety, they withdraw from the weakest first, pulling money out of Africa, Latin America, and parts of Asia. This exodus devalues local currencies, destroys purchasing power, and destabilizes governments. What began as a crisis in Wall Street's towers transforms into food shortages, riots, and political upheaval in countries far removed from the initial event. The global domino effect doesn't merely wipe out wealth, it destabilizes societies. Even nations with stronger economies are not immune. Europe, tied to Wall Street through both trade and finance, finds its recovery efforts undone as markets unravel. Japan, already balancing deflationary pressures, faces a renewed collapse in exports. China, though rising in influence, cannot escape entirely, for its own markets are tied to global demand. In every case, the fall of Wall Street sends tremors through domestic economies, reshaping alliances, strategies, and priorities overnight. No nation can stand apart when the dominoes begin to fall, because all have tied their fortunes to the same global system. The final and perhaps most devastating element of the domino effect is time, or rather the lack of it. Crises once unfolded over months or years, giving nations opportunities to respond. In today's world, the speed of collapse leaves no such window. What begins as a collapse in one market on Monday morning becomes a global rout by Tuesday. Policymakers scramble to react, but their tools, interest rate cuts, liquidity injections, stimulus packages, require time to filter into the economy. By the time they are deployed, the damage is already irreversible. The dominoes have already fallen, and the world is left to pick through the ruins of a system that was far more fragile than it ever admitted to be. The lifeblood of Wall Street is not innovation, production, or even trade. It is debt. Every major institution, every corporation, and every investor is tied to a system that has transformed borrowing from a tool into a weapon. Debt has grown from a necessity of business into the cornerstone of financial growth, the very fuel that allows markets to soar higher than their foundations justify. And when combined with speculation, it becomes a force not of stability but of destruction. To understand the hidden weakness of Wall Street, one must examine how debt and speculation intertwine, creating a cycle of illusionary prosperity that can vanish in a single night. Debt is not inherently destructive. At its core, it is a mechanism to finance growth, to build infrastructure, to create opportunities. But Wall Street has taken this mechanism and stretched it beyond recognition. Corporations borrow not to expand factories or innovate products, but to repurchase their own shares, boosting stock prices artificially. Hedge funds borrow to leverage their bets, amplifying potential returns while magnifying risks. Banks borrow short-term money to invest in long-term assets, leaving them exposed to the slightest shift in interest rates. Households are encouraged to drown in credit cards, student loans, and mortgages to keep the wheel of consumption spinning. In each case, debt is not used as a bridge toward real growth, but as scaffolding propping up structures too weak to stand on their own. Speculation thrives on this scaffolding. Investors no longer focus on the intrinsic value of a company, but on the movement of its stock price. They speculate on expectations, on whispers, on trends created by other speculators. Wall Street rewards not patience, but speed, not discipline, but daring. With every layer of speculation, the distance from reality grows. A stock valued at 10 times its earnings can still be justified as healthy, but when markets reward companies with valuations 50 or even 100 times earnings, it is clear that speculation has replaced reason. The market becomes a casino where chips are borrowed and the house is blind to how deep the players' debts have become. The combination of debt and speculation creates an unstable loop. Debt fuels speculation because borrowed money magnifies every bet. Speculation justifies more debt because rising asset prices make lenders believe risk is low. Together, they inflate bubbles that seem unbreakable until they burst. The housing bubble of the mid-2000s was not just about families buying homes. It was about banks packaging those mortgages into securities, investors speculating on their safety, and institutions borrowing further to gamble on derivatives tied to those securities. It was a tower of cards, each level supported by borrowed money and blind optimism. When the bottom faltered, the entire structure collapsed, proving how fragile prosperity becomes when it is built on leverage and gambling. Derivatives stand as the purest expression of this cycle, designed as tools to hedge risk. They have become instruments of speculation, so vast that their notional value dwarfs the global economy itself. Credit default swaps, interest rate swaps, options, and futures are traded in volumes no real-world production could ever justify. Theoretically, these instruments spread risk. In practice, they concentrated in hidden corners of the market. One mispriced derivative, one miscalculated exposure can trigger obligations worth trillions. Debt ensures that no institution has the liquidity to cover those losses outright, while speculation ensures those obligations are multiplied across countless portfolios. It is a shadow economy built on promises, fragile and combustible. This debt-fueled speculation also corrodes discipline. When money is cheap, caution disappears. Central banks slash interest rates, intending to stimulate growth. But in Wall Street's hands, low rates become a license to borrow endlessly. Why save when borrowing is nearly free? Why resist risk when rising asset prices seem to guarantee returns? This environment breeds recklessness. Institutions take risks they would never consider under stricter conditions. Investors chase speculative gains instead of sustainable ones. The very policies meant to stabilize the economy become accelerants for instability, feeding a cycle where debt piles higher and speculation runs wilder. Another layer of fragility comes from moral hazard. Wall Street has learned that when the bets go wrong, someone else bears the cost. In the 2008 crisis, banks leveraged themselves to dangerous levels, speculated recklessly, and collapsed under the weight of their mistakes. Yet rather than facing extinction, they were rescued with taxpayer money. The lesson absorbed was not caution, but confidence. Confidence that no matter how large the risks, system would not allow them to fail. This safety net encourages even greater borrowing and even riskier speculation. Why fear collapse when collapse has been repeatedly prevented by government intervention. But this illusion of protection only deepens the danger. The more debt and speculation grow unchecked, the more catastrophic the eventual collapse becomes when it cannot be stopped. The role of debt in speculation also distorts global markets. Countries borrow to finance deficits, issuing bonds purchased by institutions that then speculate on their value. Emerging economies borrow in dollars, tying their stability to the whims of foreign investors. When speculation turns against them, capital flees, currencies collapse, and entire nations face crises. Wall Street's appetite for speculative gains drives capital across borders, not with the aim of building sustainable economies, but with the intent of exploiting short-term opportunities. The result is volatility disguised as growth, fragility masquerading as prosperity. Even technology has amplified the cycle. Algorithms and high-frequency trading exploit micro-movements in markets, speculating not on long-term fundamentals, but on fleeting imbalances. These systems are often fueled by leveraged positions, where tiny profits are multiplied by massive debt exposure. The speed at which they operate means that speculation is no longer just a human impulse, but a machine-driven imperative. Markets now move with a volatility disconnected from human reasoning, and the debt underpinning those movements ensures that small errors can trigger massive losses instantly. Debt and speculation also erode trust. Ordinary investors once believed in the stock market as a place where long-term investments would grow alongside companies. Today, they watch as insiders manipulate markets with leveraged buyouts, speculative short squeezes, and algorithm-driven volatility. Confidence weakens as people realize that the market no longer reflects the real economy, but a distorted game played with borrowed chips. When trust fades, even the illusion of stability is endangered, because confidence is the last barrier holding the system together. The true danger is not just the scale of debt or the extent of speculation, but their invisibility. Balance sheets hide leverage through accounting tricks. Derivatives are kept off official records. Speculative positions are disguised as hedges. Regulators are left in the dark, relying on incomplete data, while institutions assure them that risks are under control. This opacity ensures that when the collapse comes, it is not gradual but explosive. The risks that were invisible suddenly materialize, and the system realizes too late that the debts cannot be paid and the bets cannot be covered. The role of debt and speculation, then, is not peripheral to Wall Street, it is central. Every rally, every boom, every wave of supposed prosperity has been built on these foundations. And while they create the illusion of strength, they also guarantee fragility. The system cannot function without them, but it also cannot survive with them indefinitely. This contradiction is the essence of the danger, a cycle that grows more unstable with each passing year, waiting only for the moment when the weight of borrowed money and reckless bets becomes too heavy for the system to bear. There are truths in finance that are never spoken out loud, truths so volatile that acknowledging them openly could trigger the very disaster everyone secretly fears. Wall Street, for all its glamour and dominance, survives not on transparency but on silence, and within that silence lies the unspoken warning. Insiders know it, regulators sense it, and executives whisper about it in closed-door meetings. Yet the public remains oblivious, fed carefully curated narratives designed to preserve confidence. The unspoken warning is not a single sentence, but a climate of unease, a recognition that the system is far weaker than it admits, and that one shock, one revelation could send it spiraling beyond control. This warning manifests first in the language of those who control the markets. Financial leaders speak in coded terms, never admitting fragility directly. A statement about market adjustments may conceal fears of collapse. Talk of temporary liquidity challenges often hides the reality of a credit freeze. Even phrases like technical recession are designed to soften the blow, creating distance between the truth and the audience. Behind those carefully chosen words lies the unspoken reality. The system is stretched to breaking, and those inside it know how easily it could unravel. Their restraint is not a sign of calm confidence, but of deep concern that blunt honesty could ignite panic. The reason this warning cannot be spoken is because confidence is the foundation of the entire system. Banks depend on depositors believing their money is safe. Investors depend on markets continuing to rise. Consumers depend on credit flowing smoothly. If any one of these groups loses faith, the system falters. Imagine a bank admitting it is short on liquidity. Depositors would rush to withdraw funds, creating the very crisis the admission was meant to avoid. Imagine Wall Street acknowledging that asset prices are inflated beyond reason. Investors would dump stocks, bursting the bubble instantly. This is why silence prevails, because speaking the truth would become a self-fulfilling prophecy of collapse. The unspoken warning is also reflected in behavior. Central banks, for instance, often intervene subtly before crises become visible. They inject liquidity quietly, adjust interest rates preemptively, and coordinate with other institutions under the guise of routine operations. Yet these moves are signals that insiders perceive danger long before the public sees it. They will never call it panic, but the actions themselves betray the anxiety. Similarly, corporations take defensive measures without fanfare, cutting costs quietly, hoarding cash reserves, refinancing debt before maturity. These decisions are not presented as signs of weakness, but as strategic adjustments. In reality, they are preparations for storms the public has not yet been told exist. Conversations among insiders reveal the deepest layers of this unspoken truth. Executives admit vulnerability behind closed doors. Hedge fund managers discuss risks privately while projecting confidence publicly. Regulators warn governments in confidential memos that never see daylight. Leaked emails and off-the-record comments occasionally expose fragments of these discussions, hinting at fears never shared openly. The warnings are real, but they remain unspoken to avoid triggering the very collapse they predict. Silence becomes the last line of defense against chaos. Another dimension of the unspoken warning is the systemic dependence on illusions. Wall Street thrives on the belief that problems are manageable, that downturns are temporary, and that regulators will always intervene. This belief holds markets together, but insiders know the truth is less comforting. They know leverage is too high, that derivatives are too complex, that debt loads are unsustainable. They know the too big to fail institutions are in fact too fragile to withstand genuine shocks without extraordinary rescue measures. They know that central banks are running out of tools, with interest rates already low and balance sheets already bloated. These realities cannot be admitted because they undermine the illusion that the system is secure. The unspoken warning is that the next crisis may not be stoppable by the methods used in the past. The silence extends beyond institutions into the realm of politics. Governments are equally complicit in suppressing warnings. A politician cannot admit that the financial system is at risk without undermining public trust, investor confidence, and voter stability. Instead, they frame economic weakness as temporary, assure citizens that recovery is underway, and dismiss warnings as exaggerations. Yet, in their private councils, they prepare emergency legislation, draft bailout frameworks, and negotiate international backstops. The contradiction between public optimism and private preparation is itself the clearest sign of the unspoken warning. Leaders know collapse is possible, even likely, but they cannot risk saying so aloud. Even the media plays a role in suppressing this truth. Financial journalists rely on access to insiders, and with access comes restraint. They may hint at risks, publish cautious analyses, or report on volatility, but they stop short of declaring outright fragility. Alarmists reporting risks, causing panic, and panic damages the very system they cover. Thus, the most dangerous truths remain buried in opinion columns or academic reports few will ever read. The narrative presented to the masses is one of reassurance, punctuated by controlled admissions of challenges or headwinds. The full scope of danger is rarely acknowledged until it has already erupted into crisis. The unspoken warning also exists in numbers that are technically public, yet effectively hidden. Financial reports contain footnotes that reveal risks buried under jargon. Balance sheets list exposures that only experts can interpret. Risk assessments are published with caveats so dense that their meaning escapes most readers. Insiders understand these signals immediately, but the public sees only the headline figures: earnings per share, GDP growth, unemployment rates. The deeper truths, the ones hinting at instability, remain invisible, except to those trained to look for them. The warning is there, but it is encoded, requiring translation the average investor never receives. At its core, the unspoken warning is about fragility masked as strength. Markets rally on headlines of resilience, yet insiders hedge their positions aggressively. Banks announce strong capital buffers, yet quietly limit lending. Corporations report record profits, yet issue bonds to cover operating expenses. Every outward display of confidence is paired with private moves to shield against collapse. The disconnect is intentional, a performance meant to keep the system running a little longer, to delay the inevitable reckoning. This warning cannot remain hidden forever. Cracks always surface eventually, whether through sudden defaults, unexpected losses, or market volatility too extreme to ignore. When those cracks appear, the silence of the past becomes damning evidence that insiders knew more than they admitted. But until that moment, the cycle of silence continues, because speaking openly about the danger would not prevent collapse. It would hasten it. Thus, the unspoken warning lingers in the background, shaping decisions, guiding behavior, and haunting the very institutions that depend on its secrecy to survive. When Wall Street falls, the world does not simply endure a financial setback. It experiences a transformation so profound that the contours of power, wealth, and influence are redrawn almost overnight. The collapse of the most powerful financial engine on earth would not be an isolated tragedy. It would be a global event whose aftershocks reshape entire civilizations. The narrative does not end with the crash itself. In fact, the crash is only the beginning. What comes after collapse is a reordering of systems, alliances, and destinies, leaving nothing untouched from the stock trader in Manhattan to the farmer in rural Asia. The first phase after collapse is chaos. Markets freeze, liquidity evaporates, and fear spreads like wildfire. People rush to banks only to discover withdrawal limits. Credit cards are declined, loans are suspended, and salaries delayed. What was once a seamless flow of money grinds to a halt, revealing just how dependent modern society is on invisible financial currents. The panic extends from the financial elite to ordinary households. Families who believed their savings were secure learn that paper promises do not always convert into real value. Panic buying of essentials begins, hoarding spreads, and supply chains fracture. The crash that started in balance sheets quickly translates into shortages in stores, disruptions in fuel, and the collapse of everyday conveniences. Governments respond with emergency measures. Central banks slash interest rates further, print vast sums of money, and launch bailout programs on a scale never seen before. Yet, each attempt at stabilization carries consequences. Printing money to inject liquidity erodes trust in currency, fueling inflation that erases the value of wages and savings. Bailouts aimed at rescuing failing corporations and banks inflame public anger as citizens witness the wealthy shielded while the poor struggle. Political leaders deliver speeches promising recovery, but beneath the surface they scramble, aware that the collapse has exposed vulnerabilities too great to patch with temporary fixes. The very legitimacy of governments is questioned as people realize the safety nets they trusted cannot withstand such shocks. The collapse also shatters the illusion of American financial dominance. For decades, Wall Street symbolized the epicenter of wealth creation and global trust. Its fall signals the end of an era where the US dollar was unquestioned as the world's reserve currency. Nations that long resented dollar dominance seized the opportunity to promote alternatives. Trade blocs explore regional currencies. Gold, long dismissed as archaic, surges back into prominence. Cryptocurrencies, once mocked as speculative toys, become havens for those seeking refuge outside traditional banking systems. The financial order fragments, no longer united by a single backbone but scattered into competing networks. This shift does not bring stability. Instead, it ushers in uncertainty as nations and institutions compete to shape the next global standard. Wealth itself undergoes a dramatic reallocation. Those heavily invested in equities, bonds, and financial derivatives watch fortunes evaporate. Billionaires lose more in days than they accumulated in decades. Pension funds collapse, leaving retirees stranded with no safety in old age. Meanwhile, those holding tangible assets, land, commodities, rare resources, find themselves in positions of unexpected power. Wealth shifts from digital abstractions on screens to the physical and the concrete. Ownership of food, energy, and infrastructure becomes more valuable than ownership of financial instruments. In this new reality, the definition of prosperity changes. The social consequences are equally severe. Rising unemployment, evaporating savings, and collapsing credit systems ignite unrest. Citizens, disillusioned by the failure of financial and political elites, take to the streets. Protests swell, and in some nations, they transform into revolutions. Governments fall under the pressure of economic despair, replaced either by populist movements promising vengeance or authoritarian regimes promising order. The collapse of Wall Street becomes not only an economic event, but a catalyst for political upheaval worldwide. Countries fracture along ideological, ethnic, or class lines as the stress of financial destruction exposes underlying divisions. In the aftermath, a new hierarchy of nations begins to form. Countries less dependent on debt-driven economies, those with strong reserves of resources, and those with disciplined financial systems rise in influence. Emerging markets, long overshadowed by Wall Street's dominance, suddenly become critical players. Nations in Asia, Africa, and South America leverage their commodities and growing populations to assert independence. The balance of power tilts away from the West, and alliances shift accordingly. Formerly secondary players become central in shaping the future economic order, while established powers scramble to retain relevance in a world that no longer revolves around their financial institutions. Technology also reshapes the landscape after collapse. Digital finance, already growing before the crisis, accelerates in adoption. Cryptocurrencies, decentralized ledgers, and digital wallets fill the vacuum left by failing banks. People no longer trust centralized institutions to protect their wealth, turning instead to systems beyond government reach. This decentralization fractures the financial order further, empowering individuals and communities at the expense of traditional banks and regulators. Yet, it also creates new risks as cybercrime, digital fraud, and unregulated markets flourish in the chaos. What emerges is not a safer system, but a different one. Decentralized and volatile, reflecting the distrust sown by collapse. The cultural impact of collapse is profound. Generations raised to believe in the security of markets, the reliability of banks, and the inevitability of progress find themselves stripped of illusions. The mythology of endless growth dies abruptly. People reassess what matters, shifting priorities from accumulation to survival, from speculative wealth to tangible security. Trust in institutions, once the bedrock of modern society, is permanently weakened. Communities turn inward, focusing on local resilience rather than global integration. The dream of globalization, once celebrated as unstoppable, is replaced by fragmented realities, where nations and communities seek to protect themselves first. Even nature and the environment are not exempt from this transformation. With economies weakened, funding for green initiatives falters, slowing the fight against climate change. Yet, paradoxically, reduced industrial activity temporarily lowers emissions, creating a short-term reprieve. Resource scarcity becomes more visible as competition intensifies. Access to water, arable land, and energy grows central to geopolitical conflicts. Collapse thus ties humanity's fate not only to financial markets, but to the very physical resources upon which civilization depends. Over time, a new equilibrium does emerge, though it is unlike the world that came before. The financial giants that once dictated global direction may not recover their former glory. New institutions rise, built on different principles, yet still vulnerable to the same cycles of greed and fear. People adapt to realities where volatility is constant, where security must be built through resilience rather than trust in distant institutions. The lessons of collapse linger in memory, shaping decisions, laws, and behaviors for decades to come. The collapse of Wall Street in its aftermath becomes more than a financial crisis. It becomes a turning point in the trajectory of human history, reshaping power structures, redefining wealth, and rewriting the rules of survival.